Hey guys, welcome to another Trade Genius podcast. Bob and Phil here as always. Guys, we may be going into one of the biggest recessions, if not depression, that we've seen maybe since the 20s. We're going to talk about why we think that is in this video. Let's dive in.
Trade Genius.
Hey everybody, it's Bob with Trade Genius. Usually I do fun ads. I talk about our service, but I want to be serious with you for a second. We've been helping a lot of people trading for a long time. As you can see here, I want to let them do the talking for me for a change. But most importantly, we want to help you too. If you've not joined our service yet, come check us out, tradelikeagenius.com. Full service. You know, we have chat room. We have the algorithms for you. We give trades out every day. We educate you. So go to tradelikeagenius.com. Check us out. What you get out of our service is much, much more than what you put into it. And we'd like to see you in the room. Thanks for listening.
All right, Bob. So we're starting to see we got new all-time highs. That plays into our pump before the dump thesis that we've been hammering on. But we got to really, I think the folks need to pay attention to this video, because if we start looking at some of the stuff that's popped up recently, I don't know how you're going to argue that everything's just fine and dandy. And the Fed's kind of got handcuffed here with inflation.
Phil, I never seen a press release on a public company like we've seen here with Under Armour, basically saying they're using the word collapse in demand. I mean, that is unheard of.
Right.
You know, but it goes to what I've been saying and what you've been saying for a long time is that at some point people are out of money and they have to make decisions. And, you know, clothing is one of those nice to haves. You know, it's funny. I was thinking about this last night, even before we saw this Under Armour announcement today. You know, when I was growing up, we got clothes in August, maybe some clothes at Christmas, and maybe some clothes for your birthday. And when I'm talking about clothes, I'm talking about here's your pair of jeans, you know, here's your church slacks, and here's a couple t-shirts, you know, and we turned this into like people have to go to the mall like every other week to buy clothes. And I think, unfortunately, what's going to happen out of all this, we're going to go back to, you know, the basics, if you will, in terms of how people are going to live to survive and, you know, not just spend because they're spending. And that brings up, let's start the chart Under Armour first. This is pretty fun. I'll let you talk about the chart and then we'll bring the next slide up after this. This chart's amazing. Guys, this is what an Eiffel Tower looks like after it falls over.
Right. Yeah. I mean, one thing we've said is that we had a big pump off of COVID, but a lot of stocks, even as early as 2022, started to retreat to their pre-COVID levels, and some haven't yet. But this stock, not only did it retreat to its pre-COVID levels, it went back to 2010. And I think that's symptomatic of what we're going to see, especially in retail stocks. I think we're going to see a lot of, you know, the discretionary spending stuff is going to get hammered badly. And you're going to go into more, you're going to have to be more defensive in your approach in your portfolio over the next, you know, 12 to 18 months with staples. And I think more importantly, bonds, just to kind of hide out in bonds and get that yield while everything else is taking a dump. Because make no mistake, at some point, the fundamentals do end up making their way into the way that the market is being priced. You're just having this, you know, you have to understand markets can be irrational longer than you can stay solvent. So you don't want to be too early in shorting this market or selling this market. But once this market does top out, I would not be quick to buy the dip, right? I think once this market tops out and you start cranking back down, when the stock market chart looks like the middle of this chart where it's big up and then starts to roll back over pretty sharply, you're not going to want to buy that dip this round. That's the big key here, takeaway. And so I think the Under Armour stock is just leading the pack here. And I think most stocks that we're going to see over the next 12 to 18 months are going to be similar in that they're going to come back down to those pre-COVID levels. Zoom out on the charts. For those of you guys that look at charts on the stocks, look at where those pre-COVID levels were at. Look at where your favorite stocks are trading at right now. And I think that's where you have to be looking as we top out over the next couple of months here.
Yeah. And Phil, the next chart I want to show here, this is why we titled the podcast what we titled it. What's really interesting is that when you have retail sales that are falling in real terms and then following in inflation adjusted terms, that's not good. What that's telling us is that volume is falling faster than prices can rise. And that is a deflationary, depressionary type of scenario where no matter what price you want to set as a business owner to make your margins, because your costs are going up in terms of things that you have to spend money on, right? Rents we're still locking in higher, electricity's higher, maintenance costs are higher, people cost more, materials cost more. So ergo, you're going to raise your prices, right? Well, the consumer has a vote here, and they're voting to simply not buy your stuff. And that's what this retail sales number shows you, is that when you have an environment, I call it inflationary depression, where prices might be rising, in terms of the headline, but the unit volume is falling faster than the price rise as a percentage term, and you end up having lower revenue. And then you're screwed as a business. And then we're going to start seeing more and more companies in this environment. And it's going to start with, like Phil said, Under Armour's classic is what we've been talking about in terms of, I don't need Under Armour garment, right? I don't need Lululemon products. Those are the places you start looking. Airbnb had a gap down this quarter for the first time in a long time, and it's still needing oxygen. And so you have to start watching all these guys now in the coming quarter or the coming confession. I guarantee you, Under Armour made that announcement. Every analyst and their brother now is contacting management of every clothing and any apparel company and any discretionary company out there, fashion-wise, perfumes, et cetera, et cetera, et cetera, saying, are you seeing the same problems that Under Armour is seeing? Right. And I would guarantee you, they'll tell them no, but the truth is it's yes. And it's going to become more and more prevalent as a problem. Just the other day, Phil, somebody said, here, we're going to paint their house, $45 a gallon for paint. They said, we can live with the paint for a while. And I think you're going to see more and more of that stuff. And the last thing we want to show you, because there's a trade here we could share with you, is Tesla. It goes along the same lines. It's not just clothing. You don't need an EV. You don't need a Tesla, right? And Tesla's on the lower end of the cost spectrum, if I'm not mistaken. They have product that in normal times would be relatively, I think, affordable for people, and they can't sell them. They're just not selling, and they're running out of places to hide them. And in Belgium, China is trying to flood the market with EVs, and the Belgian port is full. They can't take on any more cars in their port car lot because they're not moving off the lot into dealer showrooms. They're stuck. They're not being purchased. And Belgium's going to put a kibosh, or EU is going to put a kibosh, and then Biden has put a 4x tariff on Chinese EVs. So it's going to be really nasty out there. And there's a trade that you could take that actually, Phil's right. You don't want to short too early, but there's a product out there now that allows you to develop some income yield, so you can do a dividend recapture, drip program while you're waiting, and it's called CRSH, called Crash, and they look at being able to optimize selling of Tesla over time. It's a fairly new product from a company that has products out for a while. So I take a look at it. It's really interesting. I personally bought some, and I actually bought more today, and I'll be working towards a full position, and I'm dripping that so I can add shares, to get through this summer pump. And I think even with the summer pump filled, Tesla will probably go up with the pump, because everything now is going to start correlating really closely. I think everything's going to move with the pump, just like we saw yesterday with the market, and everything's going to fall with the market when it goes down because there could be no place to hide. So we're going to go from rotation into actually liquidation. And the way you're going to see that is when you see energy down, market down, metals down, then you're getting a liquidation market. And those are things you start paying attention to. Give you the last word, Phil.
Yeah, agree with that. And also, I think that's why Tesla's stock has been suffering, is because this was a known problem that they'd end up having to stuff channels basically. And we're either going to see, well, I know this is why we've seen the low APR financing in-house. I think you're going to see tremendous lease deals. So if you're in need of a car for the next couple of years, you might be better off leasing with probably extremely low rates and a low MSRP to base that rate off of. So something to think about. The other thing, Bob, I wanted to leave everybody with was the industrial production. We haven't really talked about industrial production or shown this chart on the podcast, but I think it's worth discussing that as we're talking about, the rot that's going on under the hood. 11 out of the last 13 months, Bob, we've seen negative industrial production growth month over month. And it's not a new phenomenon. I mean, this has been a problem since back in 2022. And really, I think since post-COVID, it's been an issue. So I think we've gotten into an environment where we stimulated the just an incredible amount of money into the economy, gave out a bunch of money, PPP loans and all this stuff that didn't have to get repaid. We're awash with inflation. Fed's trapped. Can't really do anything with rates because then you get into the stagflationary environment, which is really bad. And your production engine under the hood is going nowhere, right? Other than seasonal pops that we get in Q1 for industrial production, there's really nothing, there's no growth here. So I don't think the GDP numbers are really reality from what they're telling us. And I think eventually even those fake numbers are going to go negative. So I just think that, again, we're going to get a pop. We're going to get a pop before a recession, but I would not underestimate how deep this recession can be. And I think it's just be defensive going forward, especially as we go into, I think Bob is saying August, and I tend to agree with him in terms of where this thing might top out at. And it'll be really detached at that point from the fundamentals of what's going on.
Yeah, I mean, look, this economy is no joke, and don't get gaslit. It's you just look around your own environment, you could see it, and what we're going to try to do here hopefully the next couple of months is position you guys into success so that you can not only avoid making, stupid errors with the best intentions, right? But also to, there'll be some great opportunities to actually make money in this environment. And that, I plan on not being a victim here. So I think, the big boys know where to hide out. The big boys know where to trade. The big boys know how to get through this. And, we're going to be watching their activity and, take advantage of just following some of their trades here as we start lining up for, I think, a recession trade. And it all starts with Powell. Powell will give us the starting gun on this thing for sure.
Absolutely. Guys, let us know your thoughts on the data presented here today. We'd love to hear your comments in the comment section below. As always, if you are interested in navigating these markets with us, head over to tradegenius.co and check out our specials we have over there. And we'll see you guys on the next video. Thanks, Bob. Catch you guys later.
Trade Genius.